My name is Neelabh and welcome to this edition of Kuvera Insights. I'm joined today by Chintan Haria, who heads product development and strategy at ICICI Prudential Mutual Fund to discuss on what we mean by volatility and what are the various aspects of volatility and how it can impact and help us devise a better investment strategy for ourselves. Hi, Chintan. Thank you so much for joining us today.
Hi, Neelabh. Always a pleasure to connect with all of you and the listeners at Kuvera Insight.
So we'll quickly jump into our discussion. Is there any difference between different categories of mutual funds? So is there a relevant time period to look at? For example, debt funds generally, the perception is that they will be less volatile. Do you want to talk about that a little bit also?
Yeah. So in terms of volatility and time horizons, typically if you see people invest in liquid funds or overnight funds in the debt category or as parking vehicles or short-term instruments, so there the measure should be much lower in terms of how you look at standard deviation in terms of the timeline. If you look at credit risk funds or or dynamic duration funds, you will find that you have a duration of 3 years and above when you're looking at debt funds. In the equity space, I think 3 years to 5 years, like I was mentioning, is a good time period. Within equities, of course, large cap funds, you may want to look at 1 year because generally they are more steady, but mid cap, small caps, the longer the time horizon, the better because they are generally more volatile and their cycles are very sharp. When the falls happen, it is too sharp. When the rise happens, it can be very sharp as well. So I think in mid cap, small cap, it is very important to look at a longer time horizon. In sectoral thematic funds also, it is very important to look at long horizon because typically sectors, look at auto, for example, 2013 to 17, it had a good time. 2017 to 2021, it has had a bad time. Maybe next 3 years, it will do well. So thematic sectors, themes and sectors, you have a longer time horizon. Mid cap, small cap, a longer time horizon. Large cap and flexi cap or multi cap category, you can probably have a shorter time horizon in terms of your outlook. But in general, rule of thumb, 3 years is a good measure for you to look at risk reward return in terms of volatility and standard deviation.
Got it. So, of course, when one is talking about a portfolio, investing into a portfolio, like for example, a mutual fund, volatility of each instrument plays a role in, taking the volatility of the overall portfolio in a certain direction. What we understood is that volatility in a rising market, also volatility may be high in a market which moves up and down. So it does not indicate, volatility does not necessarily indicate the direction in which the portfolio may have moved in the past. So to that extent, one needs to factor that in and build or plan for their investments accordingly. Necessarily, bringing down volatility is not a goal unless it is achieved keeping the various investment objectives in mind, right? And within that framework, portfolio diversification, especially by way of investing in mutual funds, is a great way to manage volatility. Is there a way one can eliminate volatility completely from their investment?
Of course, you invest in risk-free rate or risk-free bonds, whatever it is, if it's available in investing, then you can eliminate volatility. There also, I'm sure there is some volatility, but risk-free rate by definition means that there's going to be limited or no volatility. However, in the long run, if you want to make returns which are above risk-free rate, then there is some element of risk which you will need to take, which essentially means there will be some volatility in the investments. And like you mentioned, within debt, suppose shorter-term CPCDs or shorter-term papers with lower duration and high quality have lower volatility. Let's say higher duration credit papers may have more volatility. Government bonds, which are 10-year, 20-year, can have much more volatility. So volatility by itself can be different for different instruments, and you can never make it zero, but yes, you can potentially make it your friend. And that's what we tried to do when about 10 years, 12 years back, we started promoting the dynamic asset allocation category or the balance advantage fund category. And both the balance advantage fund as well as the dynamic duration category on the debt aim to basically reduce volatility by basically moving between equity and debt in a sensible manner, keeping valuations in mind. When markets are cheap, you buy more equity. When markets are expensive, you reduce equity. And by doing this across cycles, you not only embrace volatility by not making it your enemy, by making it your friend, you also get the advantage of markets ups and downs to buy when the market is cheap and sell when the market is expensive. So I think as far as the mutual fund industry is concerned, the entire dynamic asset allocation bouquet, the balance advantage fund category is, I guess, one of the ways in which investors should look at. And in fact, we go ahead and say that have a bulk of your investments in dynamic asset allocation category, which is the balance advantage fund, because it will take care of your equity requirements and debt requirements in terms of your long-term wealth creation while keeping valuations in mind. And you cannot eliminate volatility, but through these funds and investing through these funds, you will make volatility your friend.
Understood. So, from a investing strategy perspective, there are two elements to it. One is what you do practically, in terms of asset allocation, in terms of monitoring your portfolio's returns as an investor. Alongside of that, there is also the psychological impact of all of the news flow that we are bombarded with throughout the day now, whether it's an alert on your smartphone or something you see, on a TV screen, or it may over a lunch table discussion, dinner table discussion. How does one deal with it? There is we've seen this temptation amongst investors to react to the market, while in general, when markets are moving upwards, your portfolio is moving upwards, you do not care so much about volatility, some of these measures of risk. But when the market is moving down, then suddenly there is a lot more focus on trying to look at what is the risk of investing, and though the interpretation or the outcome can be entirely different depending on which time of which phase of the market you are looking at these kind of measures. So how does one deal with this temptation? For example, we say that if the markets are moving up and you have great temptation to take a bet which is outside of your asset allocation, place a 100 rupee order in some scheme and sort of settle that temptation at that point in time, rather than swinging your asset allocation completely off balance. I mean, assuming of course that a 100 rupee investment will not swing your asset allocation that much, but volatility and asset allocation, how do they how can they interact with each other, and how should an investor react to such news flow which comes on a daily basis, while asset allocation will change gradually?
Yeah, so you're right that these days we live in an era where every second there are about 15 new pieces of information which come to our brain, and our brain is capable of listening to all of them but processing only about, I think, 1 upon 1,000 times or 1 upon lakh times the amount of information that it gathers, right? Consciously as well as subconsciously. However, I think investment is simple but not easy. And why do I say that? And these are words borrowed from obviously none other than Mr. Warren Buffett. That and I have lived 17 years of my life in the mutual fund industry, and I believe in these words that it is simple, but it's not easy. It looks simple, and having made the mistakes that I as an investor would have made in the last 17 years and continue to make, I think we keep learning from our mistakes, and as long as we don't repeat them, it's fine. We live in an information age, and hence it is important to probably cut out the noise from the information, or the relevant information, I would say. Difficult to keep pace with everything that's happening in the market, because world being a global village, everything is too interconnected. What is in your hand is in your hand. What is achievable by you, what is doable by you, you should do. And the most important aspect of financial freedom is asset allocation. And a sound principle-based asset allocation will ensure that you don't make the mistakes which you essentially spoke of, that if, for example, market is doing well, herd mentality comes in, people want to invest more when the market does well. You will be tempted to invest more when, let's say, your neighbor makes more money than you, or your friends make more money than you, and you will end up probably investing at the wrong time, which is totally opposite of what your risk appetite is as an investor, what category of investor you are, and it may not suit your investment style as well. So I think the important aspect is be true to yourself, be disciplined, and have an asset allocation plan basis your risk appetite. And then eventually all the noise, all the information will not matter. The only thing which will matter is, do I have the right asset allocation? And the right asset allocation, if you follow with discipline, will not make the mistakes of greed and fear, which more often than not are the primary reasons why people lose their wealth. People lose their wealth because they invest in things that they don't understand. People lose their wealth because they invest more when they should not be investing more in asset classes which have already done well. And hence, from an investor standpoint, forget the noise, have an asset allocation plan, keep it simple, and that's where it will become easy as well. Um, Again, it's very easy to say all of this, but very difficult to actually practice it, because there are so many forces which are impacting you. And the best way to do it is, when you are making an asset allocation plan or any investment decision, do not allow the outside noise to influence you, and don't make any investment or divestment in a hurry or in an impulse. I think write it down, have a asset allocation plan, and I think you should just be fine. And eventually, volatility is your friend if you're able to buy low, sell high. Volatility is your enemy if you end up selling when the markets are doing badly and buying when the markets are doing well. Thank you.
Understood. Couple of if I can summarize sort of what you said in 2 or 3 bullet points. Make a plan. That plan should exclude external information for you, because it comprises of what your investment goals are, what you want to achieve from your investment in terms of your financial needs or financial goals. Write down that plan. That will give understand your risk-taking capability, your investment horizon. Once you make that investment plan and start investing according to it, some of these information sort injections that keep coming on a daily basis, there will be a lesser temptation to react to it, because we are uncertain about, okay, what am I saving for? And suddenly somebody comes and tells you, okay, the price of oil is shooting up or real estate is collapsing in this market. It doesn't affect what your investment goals or your investment horizons are. And if you focus on asset allocation, and if you focus on investing according to the plan, some of this, it's a powerful tool in your arsenal to deal with this psychologically, and not just purely be reactive to the market. One technical question, and I'm not sure if we discussed this earlier, but I wanted to understand what is in the context of volatility, what is, we've often used the term drawdown, right? Can you help us understand what does drawdown mean?
Sure. Before I answer that question, just let's say a few words that came to my mind. Asset allocation can be a good vaccination against the virus of temptation. So in this of viruses and vaccinations, I thought I'll just coin this. It just came to my mind. Yeah, so drawdown, just coming back to your question. Drawdown is a concept or a term wherein how much money do you lose when the market falls in that particular investment that you have, from the peak to the bottom. For example, if during the year your money has moved from 100 rupees to, let's say, 150 rupees, and then it has come down to 130 rupees and then again gone up to 170 rupees. So in this particular instance, from 100 to 150, 150 to 130 and back to 170, the drawdown or the maximum drawdown would be 150 minus 130. So the 20 rupees or roughly the 13%, roughly 13% that you lost, that's called the drawdown. How much money did that investment lose for you? And typically, if you see, the higher the drawdowns in terms of an investment asset class, that makes that asset class that much more risky. And that asset class can potentially lead to that much wealth destruction if you invest at the wrong period of time. So in the Indian context, if I have to say, the Nifty in the last maybe 10, 12 years, the benchmark index would have seen drawdowns of 15%, 20%, 25% on each of the years, because from absolute peak it corrects, then it goes up, corrects and goes up. 2008, it had a drawdown of almost 55% plus, right? Because we fell very sharply in 2008. So if you look at drawdown, it's a simple measure by which it tells you that what is the potential loss that you can have based on past history in terms of the peak to bottom fall for that particular time period in that particular investment.
Yeah, no, I think that's absolutely spot on. I think what you mentioned, potential for loss, that is very important. And drawdown also needs to be the other context that from an investor standpoint is if an investment has a high drawdown in the past, does not mean that you've actually suffered that loss. It is, it is from the peak to the trough of that investment in that during that period. If you don't need the money, and if you made the investment according to your plan and if none of those hypotheses have changed, none of those in your investment objective, none of those objectives have changed, and the fund is or the instruments that you have invested in, if they are all invested according to the investment objective that they should have been, then you don't need to be bothered by drawdowns. And like you said, the Nifty index itself has shown 15-20% drawdowns every year for the past 15-20 years. I'm sure in many years it would be much higher than that, but 15-20% is something we could see this year or last year in the more than 20% in the last year, I think. So that's great, and thank you so much for sharing sharing your insight with us on volatility. I don't think I have any further questions, but if there is anything in general you wish to mention in the context of risk, volatility, drawdown, investing in times when markets are moving south or moving upwards, or any general comment on that would be very welcome.
Sure. So just to summarize, I think we had a nice long discussion covering many aspects. First thing is that volatility is part of investing, which you cannot take away. What you have in your hand is to have a good asset allocation plan. How much money should be in equity, how much money should be in debt, how much money should be in gold. Within that, then you can think of active, passive, ETF, index funds, large cap, mid cap, small cap, as per its suits. We generally say that have a core allocation to asset allocation schemes like the Balance Advantage Fund category. And I think the systematic investment plan, which is like that, soldier who can actually win a war for you in terms of your long-term wealth creation journey by every month or every week picking up through the systematic investment plan some units, will eventually create a war chest for you. And depending on whichever need you have, your health insurance needs, your insurance needs, your retirement needs, children's education, children's marriage, whatever a car for yourself, a holiday for yourself, each of these can be taken care of by just two simple things: have an allocation to asset allocation schemes for the long run, and invest through the SIP route, which luckily for all of us, I think India as a country has woken up to the idea of SIP, and we have more than 12,000 crores of SIP as an industry today, which is a good steady capital, which is also supporting the markets at a time where in the last 7 months or 8 months since October 2021, at least in my career of 17 years, I've seen one of the most brutal FIs selling, comparable to 2008. And while in 2008, FIs sold 5% of their then holding in Indian equities, we fell 55%, I think. In the last 7 months, FIs have sold equivalent of 5% of their holding, but we've probably fallen 12, 13%. You can see the difference, and the difference is just simply the domestic flow of capital in large amounts coming into Indian equity markets as a support. And with the demography that we have, I don't think that is changing. India is moving towards a globalized world wherein in developed markets, people used to invest in equity and create wealth. Luckily, we are also moving in that direction. And I think for you as an investor who may not understand equities or may not understand markets much and not be able to keep a lot of track, just invest through mutual funds like the Balance Advantage Fund or the SIP route. I think you'll be probably given that long-term wealth creation journey, which I think all of us deserve, because we are savers and we need to create wealth for ourselves, because inflation is going to eat away your long-term value, purchasing power of money. And so investing in equities is one of the ways of offsetting that. Thank you.
Great, Chintan. Thank you very much for your time today and for sharing those wonderful insights with us. We hope to have you back again soon.
Always a pleasure.
Thanks
So much. Thank you everyone at Kuvera. Thank you.